You know, I have an amazing point I just want to make about this. I've found that when I've looked for the obvious answers in the obvious places, I've obviously never found them. And when you look in the absolute opposite place where everybody else is looking, you're probably going to have a good chance of doing it. And I learned this from music, ironically. It is from playing Bach and counterpoint and composition, I guess. Basically, what I've found right now, working in the market the best, is not trying to hedge your risk, knowing exactly what your risk is up front, and don't try, because I've seen it. You remember when we had the flash crash in May? If people were arbitraging BGU versus the S&P 500, and BGU is a 3 times S&P 500 leverage instrument. So technically, what you could do is you could go short, 1,000 shares of BGU and long 3,000 of SPY, and you're equal. The problem was that BGU went out of calibration to the SPY index or the S&P 500 by 7 points. That's bankruptcy city for people. Even if it's for 10 minutes, I know people who got margin called right there and got liquidated. And one of the hedge fund, that guy who lost most of his money, he was one of those guys. He didn't have money at the end of that day. And I think a lot of people believe, and then also, I worked with convertible bonds, and I know I got to go here, but I worked extensively with convertible bonds. And convertible bonds are a great metric for how people think as far as an investment attitude. And people think with convertible bonds that they're taking less risks. They come up with all these ideas. Okay, well, I can, instead of buying the equity, I can get the bond, I get a coupon, and I get an option volatility element, and so I've got all these things here. And the reality is that all it takes is one thing to change in the way that these things are actually valued, measured, or executed, and you're broke. And so when the government decided that you couldn't short financial stocks, well, every hedge fund who was trading convertible bonds had a big problem because they couldn't manage their hedge ratio on these bonds anymore. And so I see those things as very, very, those kinds of out of the woodwork things are going to continue to come up for us as this deleveraging process happens. And if we don't believe that this is a leveraged problem, I'm just going to reiterate that the leverage ratio for Goldman Sachs is 457 to 1, and it's probably higher now. And it's also huge at JP Morgan. So there is a deleveraging these guys are forced to do, and it's going to affect all of us. So the best way to be prepared for it is to take risks, to take single risks, to know exactly what those risks are. And I think that's where the opportunity is, because when people look and say, look, these guys were prepared. They had a plan, they executed, I know what their risks are. They didn't come up with a big fancy smorgasbord of nice sounding words that I don't believe they can execute. That's my problem, is I think that simplify is the name of this game right now. So. Okay, sorry.
Anyway, with everything in mind, and the many difficult aspects of raising assets for alternatives. We've all heard the pitch from prime brokers before regarding capital introduction, and once you move your account to their firm, you never hear another word about raising assets for your firm. Over the past couple of months, we have seen a couple of prime brokers really, step up their efforts to help funds raise assets. And that's why we've invited George Lucaci of Direct Access Partners in New York to present on raising capital for hedge funds. They've raised over $2 billion for managers, and they have an excellent capital introduction program. So with that, he's a senior managing director. He's responsible for their capital raising group. He's got over a decade of consulting with hedge fund managers to refine their strategies and focus their brands to meet the needs of today's institutional investors. Both institutional investors and hedge fund managers alike benefit from his 20 plus years of experience profitably marketing new businesses and products on Wall Street in both the FX, fixed income, and derivative asset classes. So with that, let's welcome George. Thank you very much.
Thanks, Mike. Just one or two observations that nobody's seemed to have caught on. This microphone does not work. You guys are holding it, it doesn't work. And number two, if I was a hedge fund manager right now, I would be terribly overwhelmed with the information I got, which was exceptional. And I must say, Nicholas and Rainford, if I could get a transcript of what Rainford was talking about, I would. It was exceptional. It's so true. But it's also true specifically for pension funds who are checking every single box. And Peter, there's no doubt that then there is an inexorable move to separately managed accounts. In fact, even though we've raised $2 billion over the last 5 or 6 years, we've raised $400 million this year, so it's been a very good year for us. We are moving a multi-strat Brazilian fund, about $3 billion, onto a separately managed account platform, because I didn't think there was any way we could raise capital for them unless there was that transparency. And even though people are extremely bullish Brazil, we felt we had to get that done, and that's what we're in the process of doing now. So separately managed accounts are going to be critical. It's the way people are moving. I'm going to be very quick here because you guys have to be overwhelmed. Peter, I'm sorry, Nicholas, I'm not sure what an emerging manager definitions is. They're different from many different people. It could be two guys starting out with $5 million who understand risk and understand operations, or it could be some define it as somebody with 3 years experience and at least $50 million. We are contracted with numerous seeders around the world to find them hedge funds, and we have not been that successful in that aspect of it. They're extremely selective when they do it. It's a very small percentage, and sometimes funds who are in the business 3 or 4 years look at themselves as being emerging managers. Now, Robert, I know I gave you a lot of ideas today on what it takes to raise capital. Very quickly, Michael, you said think locally, invest globally. And I think that that's very true. And I think that when I talked to one of our wealth managers who's an investor and I looked at their funds, I was very happy to see that they weren't all New York. There was Minnesota, there was San Diego, there was somebody in Miami. So don't get frustrated that everything happens in New York. It happens all over if the funds are exceptional. So when you raise capital, I just want to make another distinction. We're not capital intro people, we're capital raisers. Capital raisers take the process from the beginning to the very end. We don't introduce somebody at a cocktail party and then hope everything turns out and that they have meetings. By the time we take a hedge fund to an investor, we have explained the strategy, we have talked about the people, and you really do have to believe in those people. And there's a lot of different things. Rainford, you're talking about looking at somebody in the eye and knowing and believing. And we can't raise capital, or nor should a capital raiser raise unless they are committed and really believe in that person and that strategy that they're involved with. You can't pick up the phone or make a meeting without truly believing in that person and what they've done. And there's a difference, when they do the checks on you, they do exceptional checks on you, some of these guys, whether they're family offices or fund of funds, there's a difference between a 20-year-old who steals a mannequin, from college and they find that on his record, or a 33-year-old who, is caught for shoplifting. And I've seen all this. There's a difference between a 21-year-old caught for drunk driving and a 50-year-old caught for drunk driving. So there's a lot of nuances there that people look at, and there's some, there's some subjectivity in all these decisions that people make. What's important in capital raising is that when you sit down with a investor, that you don't sit down and say, okay, thank you very much, I'm glad I'm here. What do you want to talk about? You can't. You've got to manage the meeting from the very beginning. And I'm just going to try and highlight on a couple things because I think it's more important to get questions from you guys. And I saw these questions here that, Michael, you sent me that were for capital raising. You've got to say, here's my agenda for today. I'd like to speak about X, Y, Z. I'd like to speak about our backgrounds. I'd like to speak about our strategy, how we look at risk, what our infrastructure is. And in case you have another agenda, I would be happy to follow that. But don't go in there unplanned and don't go in there in an ad hoc manner. That'll ruin the meeting forever.